Hello, my dear students. Myself, Badruzzaman Laskar, faculty member of SS College, Hailakandi. Today, I am going to discuss the second unit of your accounting subject, and the name of the unit is Theory Base of Accounting. In today's discussion, we will cover about meaning, nature, and importance of accounting principles. Then, types of accounting principles, that is, accounting concepts and convention. So let's start our today's discussion. To understand properly about accounting principles, first of all, we have to know about principles. What is principle? Principles is some kind of rule, belief, idea that guide you for doing a particular task or action. Now, accounting principles are the general rules and guidelines that companies are required to follow when reporting all accounts and financial data. Again, accounting principles may be defined as those rules of conduct or procedure which are adopted by the accountants usually for recording and reporting of financial data. That means accounting principles are some general rules, regulations, procedures or guidelines that are followed by the companies when they report all accounts and financial data. We can also say that accounting principles are those rules and regulations or procedures or guidelines which are adopted by the accountants universally for maintaining various accounting activities or preparing for financial statements, or we can say that for recording and reporting of financial data. Now, characteristics of accounting principles. The characteristics of accounting principles are: first is, accounting principles are made and developed by men, in brackets it is written accountants. That means these principles are developed by men. That means it is man-made. Accounting principles are man-made. Next characteristics is the general acceptance of an accounting principle usually depends on how well it satisfies three criteria: relevance, objectivity, and feasibility. That means the acceptance of accounting principles depends on how well it satisfies these three criteria. First is relevance. So what is relevance? Relevant means information will be useful to the users. Then objectivity. Objectivity implies that recorded data are reliable and verifiable. And last, feasibility. Feasibility implies that implementation of the principles in practice will be without much complexity and cost. Next, accounting principles cannot be validated, proved by reference to natural laws as in the case of physical science. That means these principles cannot be proved or validated like other natural science. Next, accounting principles are developed for common uses to ensure uniformity and understandability. That means these principles are developed for common uses to ensure uniformity and understandability. Uniformity means similar, that is not different. And understandability means information provided in the financial statement must be easily understandable to the end user of those financial statements. Now, next, accounting principles are in the process of evolution. That is, they are not in their finished form. This principle states that accounting principles are not in their finished form. That means till now research is going on accounting principles, and so now it is in the process of evolution. Research is going on till now. Now next feature is they are not rigid. This principle states that accounting principles are not rigid, or you can say that these principles are not fixed or static. They are changeable. From time to time, accounting principles may be changed. Importance of accounting principles. A. Uniformity of accounting. That means accounting principles brings uniformity in accounting practices. Uniformity means similarity, that means not different. Next, comparability of accounting information. That means if accounting principles constantly followed, we can easily compare different period of accounting informations. Next, reliability of accounting information. That means accounting informations make the financial statements more reliable and non-biased. That means biased free. Next, neutrality in accounts. That means accounting principles helps to maintain neutrally to maintain neutrally in presenting financial statements. As a result, reduced biasness. Next, guidelines to accountants. That means accounting principles provide guidance to the accountant for maintaining various accounting activities or for preparing various financial statements. Next, traditionally, accounting principles are classified into two categories. One is accounting concepts, another is accounting conventions. Now, accounting concepts includes business entity concept, next money measurement concept, next dual aspect concept, next going concern concept, next cost concept, next accounting year concept, next matching concept, next realization concept, next accrual concept. Accounting conventions include full disclosure, consistency, conservatism, and materiality. In our today's discussion, we'll just cover accounting concept portion. Okay. Now, what is accounting concepts? Accounting concept refers to the basic assumptions and rules and principles which work on the basis of recording of business transactions and preparing accounts. That means accounting concepts nothing. There are some basic assumptions, rules, procedure, principles which are followed by the accountants or business organizations for recording various accounting activities and preparing the accounts. Next, first concept is business entity concept. This states that a business and its owner should be treated separately as far as the financial transactions are concerned. That means the owner and the business are two separate persons. These principles state that owner and the business are not same. They are totally different. Owner is a natural person and business is an artificial person, so they are not same. Next, money measurement concept. Only business transactions that can be expressed in terms of money are recorded in accounting, though records of other types of transactions may be kept separately. So these principles state that we can record only those transactions which can be measured or expressed in terms of money. That means we have needed to record only monetary transactions. We exclude or ignore non-monetary transactions, or we can say that the transactions which we can't express or measure in terms of money, we can't record it in accounting. Next, dual aspect concept. For every credit, a corresponding debit is made. The recording of transactions is complete only with this dual aspect. That means every business transactions has a double effect. That is, it has two sides. One is debit and another is credit. Next, going concern concept. In accounting, a business is expected to continue for a fairly long time and carry out its commitments and obligations. That means business shall continue for a longer period, and there is no intention to shut down or close the business operation in future. Next, cost concept. The fixed assets of a business are recorded on the basis of their original cost in the first year of accounting. Subsequently, these assets are recorded minus depreciations. That means when we record fixed assets in business, we'll record it on their original cost, that is on the basis of their historical cost, and then we minus depreciations. Okay, we reduce depreciations. Next, accounting year concept. Each business chooses a specific time period to complete a cycle of accounting process, for example, monthly, quarterly, or annually, as per a fiscal or calendar year. That means life of the business enterprise is broken into smaller parts so that performance smaller parts such as monthly, quarterly, or annually, so that performance is measured at a regular interval. Next, matching concept. This principle dictates that for every revenue recorded in a given accounting period, an equal expense entry has to be recorded for correctly calculating profits or loss in a given period. That means it is necessary to match revenue of the period with the expense of that period to determine correct profit or loss for the accounting period. Next, realization concept. According to this concept, profit is recognized only when it is earned. An advance or fee paid is not considered a profit until the goods or services have been delivered to the buyer. That means revenue is considered as being earned on the date at which it is realized. That is, on the date when the property in goods passes to the buyer and becomes legally liable to pay. Next, accrual concept This is the most fundamental principles of accounting, which requires recording revenues when they are earned and not when they are received in cash, and recording expenses when they are incurred and not when they are paid. That means we record revenue when they are earned, not when they are received in cash, and also we record expenses when they are incurred, not when they are paid. We can also say that we make record of all expenses and incomes relating to the accounting period, whether actual cash has been distributed or received or not. Okay, so thank you to all.